welcome to our webinar where we're going to be discussing optimizing Roth conversions while managing thresholds for income-related monthly adjustment amounts, or as I'll be abbreviating it today, IRMAA. And just before we get started, some quick housekeeping items. The session is going to be recorded in full, and we'll send a copy to each one of you at the end of the webinar. And time permitting, we're also going to have a Q&A session at the very end. So please feel free to submit questions, throughout the webinar as questions come to mind. But anyways, looking at our agenda today, we are going to be reviewing a few different things. So firstly, what determines our different IRMAA thresholds. We're going to be viewing some comparisons in taxes through IRMAA-based conversions. And then we'll highlight modeling multiple tax strategies. And we're going to do all of this in a live RightCapital client plan today. And as always, I will spend some time at the end highlighting some advisor resources and again, answer any questions. But anyways, without further ado, why don't we take a look at the plan that we're going to be checking out today? So for this plan here, we're going to get some context on the background before jumping right into the conversions. But the plan we're looking at today is a very recently retired couple, both aged 62. And starting here in the profile blueprints, we're going to get some good context into where they stand as of today. And taking a look at their net worth, they're in a very solid position. As you can see, they've accumulated a strong portfolio across each of their accounts, as well as their jointly held accounts. They have a high valued home, some life insurance policies, and minimal debt, just a few years remaining on their 30-year mortgage. And taking a look at their income here, right as retirement's getting started, in this case, they did decide to take Social Security as early as possible, age 62 here. And they do have a joint annuitized annuity that's going to be granting them income throughout retirement. But even beyond that, between their housing costs, their expenses on their liability, some insurance premiums, as well as their goals in retirement, those stable income sources are not going to be enough to cover all of their expenses. So outside of those costs I just mentioned, they're also going to be spending $8,000 per month on day-to-day monthly living expenses. They will also have an annual vacation goal for $6,000. Towards the end of the plan, they're going to both be assuming they will be going to a nursing home. And for our big topic of discussion today, they'll also have some annual retirement healthcare costs. And this is really important to note up front, because especially as we talk about IRMAA, there is the caveat that this specific entry in the profile goals section needs to be set to detailed estimate. Why is that? Well, because this is the only option that is actually going to estimate Medicare based off their AGI, or as we'll look at, their modified AGI. So without this option selected in this specific entry, we're not going to see any IRMAA surcharges. The other options would either be a national average that just inflates with our healthcare inflation assumption, or a customized amount that you entered that will also be inflated. But when we actually base it off our AGI, well, then we're actually going to be able to show the effect of IRMAA in our client plans. But ultimately, with all of these costs that we're seeing here in the goals section, a big part of their retirement is going to be covering these expenses with their portfolio that they've accumulated. So that's going to be a really key part about our discussion. So as one last area to check out before we head to the tax strategies tab, if we take a look at their portfolio in this plan, they have a very balanced approach with a 50-50 portfolio. And we're projecting 7.5% return and 8.8% deviation. But the really key reason I bring this up is going to be the tax allocation. So the tax allocation is going to show us the breakdown of all of their portfolio between their taxable assets, tax deferred, and tax-free assets. So taking a look at this plan, despite accumulating a portfolio of over $1 million, a lot of their money is tied up in their tax-deferred assets. And that helped them a lot in pre-retirement accumulate this wealth, of course. A lot of these savings being pre-tax and not taxed until, well, here in retirement. So this is also the thing we are going to be solving for today, because with all of the portfolio withdrawals, as well as RMDs looming right around the corner, this part of their portfolio is going to be generating a lot of taxes and ultimately a lot of withdrawals from their portfolio in general because of these added taxes. So, and just to view in here, they have 2 buckets of money in their tax deferred accounts, an IRA and 401k. So these accounts are both eligible for Roth conversion, which really takes us to our main area of the software I want to review today. And for those of you who are new, this is a very popular module, but what I'm referencing here for solving for tax efficiency and savings is going to be under the tax module up here and the tax strategies subtab. And ultimately, this module can do many different things. But in terms of breaking down what it does in a very general sense, first, it's really solving for 3 things at a high level. So that's what we're seeing right here on this summary subtab. So we can build strategies that will hopefully accumulate a higher ending portfolio value, can either minimize or make federal taxes paid over the total timeline of the plan manageable or lower than in our current plan. And this also goes hand in hand with what I'm talking about today about minimizing withdrawals from tax deferred accounts, because that's just added taxes, which will be added expenses, which means more overall portfolio withdrawals in many cases. So these are really the 3 things we're solving for. But like with all areas of RightCapital, the action items is where we actually do some of the solving. And there's 3 different strategies that we can mix and match to solve for those areas I mentioned above. So first listed here is the asset location and our equity allocation strategy. So ultimately, this is basically proposing that equities be prioritized or not prioritized into certain tax buckets. So for example, if we wanted to ensure that of our 50-50 portfolio, more of our equities were in the Roth bucket rather than the other, taxable tax deferred buckets, we could update this to prioritize our equities to a certain tax allocation. Asset withdrawals is a very common one as well. So asset withdrawal is focused on when I was alluding to those deficits that the clients were experiencing. So cash flow deficits, they need to fund expenses with their portfolio rather than stable income sources. Where are we going to pull from to cover those expenses? So there must be some sort of sequence to pulling money out of our portfolio. By default in RightCapital, we're going to be pulling from bank accounts and taxable investments first. And then once those are depleted, move on to tax deferred money until that is depleted. And then finally, if necessary, dip into the tax-free accounts. But again, this can be customized as a part of your proposal in this section. But really, the main focus of our conversation today is going to be this final and most popular section for Roth conversions, because this tool lets you build tax efficient Roth conversions with just a few action items we see here on the bottom. Now, first of all, I do have some pre-built assumptions in here. So I've already tied all conversions to begin as soon as possible, but end right before RMD age for both of our clients here today. And then I also have an estimated terminal tax rate assumption. So this is an assumption that's specifically localized to this module. And basically, this is the concept that dollar for dollar, a tax deferred account is going to be a little bit less valuable when you pass it to heirs because of the taxes and the withdrawals that they're going to have to take from a tax deferred inherited IRA versus a Roth IRA. So that's a pre-built assumption. You can certainly manipulate either of these assumptions, but I will be keeping these static for the different plans I'm reviewing today. The real focus and the primary thing that's actually creating the Roth conversions are these two action items right here: conversion target and fill up the tax bracket. And for those of you that haven't used this module, I'm going to first start with an ordinary income tax bracket before we get to the IRMAA brackets. So I ultimately think the best place to visualize what filling up the tax bracket is doing is over here in the calibration tab. So if we take a look at this and take a look at what our current plan or reference strategy is doing without any conversions, is what we're seeing is we're going to see for ordinary income tax brackets, our adjusted taxable income year over year for this household in this blue background here. We're also seeing, in this case, 3 ordinary income tax brackets. I do have the assumption right now that TCJA is not sunsetting. So that's what these ordinary income tax brackets correlate with here. And another important part about this module is you can also click on the legend of the graph to hide or add certain thresholds. But anyways, what we're looking at here is year over year, what ordinary income tax bracket are they in? So the concept of this tool is if I choose to fill up a tax bracket, I am going to do as many conversions as possible without one breaking into the next tax bracket, and only if I have assets that are available to be converted. So any year we're under the threshold indicated and have assets that we can convert, we're going to estimate the maximum we can convert in every calendar year. Those two rules are applicable. So just very quickly here for this one, I'm seeing early on in the plan, because again, my conversions are before RMD age, that they're right around the 12% tax bracket here. So I'm going to try a strategy to fill up to the 22% and hit refresh. And basically what we're going to see, and to hide this, so this is our taxable income without conversions. This is now going to be our adjusted taxable income with conversions. So what I'm seeing here is we're maximizing the 22% tax bracket. Why is our taxable income higher? Because of the conversions we're doing. And to see what we're actually converting, well, actually, before I get there, right away, we're going to see some results from this strategy and some quite beneficial results for this particular client plan. It's going to highlight how much more in ending asset value we're going to have. If we want to see the actual conversion amount, we could go over to this details tab, and we're going to see a few different things here. But right away, under withdrawal and conversion here, we're going to see how much we're converting while staying under that 22% ordinary income tax bracket threshold. Here it's stopping at age 71 because our tax deferred account balance is running out. We don't have any more money to convert in this scenario. Now, this is very tax efficient for, ordinary income tax brackets and just tax payments in general. But one thing this strategy doesn't account for is, well, the topic of discussion today, IRMAA surcharges. So here in this details tab, we're also going to be able to view our Medicare premiums if, again, going back to that goals entry for annual retirement healthcare cost, that needs to be set to detailed estimate for this. But taking a look at Medicare premium, we're going to see our modified AGI each year, which determines our IRMAA surcharges. And we're going to see our Medicare premium threshold each year once they turn age 65. And this is the bottom threshold. So no IRMAA versus we'll start to get IRMAA surcharges. But one important thing to note about this and to remember about IRMAA surcharges in Medicare is it does have a 2-year look back, right? So for Medicare premiums here in 2030, for example, my Medicare premium threshold is $239K, but it's always looking at the Magi from 2 years ago. So in this case, $329,000. So in 2030, they are getting some IRMAA surcharges. And if I go back to the calibration tab, where we can see our tax bracket thresholds, we do have the ability to swap which thresholds we're looking at. So if we want to look at these IRMAA thresholds, we could swap over to this Medicare premium tax bracket and view them here. So if I zoom in here just for a second, basically with our ordinary income-based conversion, we are getting some pretty significant IRMAA surcharges here early on because we're above this no IRMAA threshold, this blue line here. But we can also build Roth conversion strategies based off these IRMAA thresholds. So we can both be tax efficient and then also care for the client's IRMAA surcharges that they may experience over time. So although this is a beneficial strategy, we may want to try a different strategy. So one cool new feature that was added to tax strategies is we're not locked into one Roth conversion or one tax strategy in general. We can create additional strategies to try. So instead of overriding my existing proposed strategy, I can go into this edit button towards the bottom and I can click add strategy. And I can go ahead and create a strategy for no IRMAA. And if I go ahead and save that, again, I'm going to be able to create an additional strategy. And what I need to do here first is swap my proposed strategy in the action items to the new proposed strategy I just created. And we can see that fill up the tax bracket as well as the timing got reset. So for this no IRMAA strategy, I'm going to go back into edit, make sure we can do the same time frame here, which was Chandler's age 74. And in addition to that, I can also change my conversion target to these Medicare premium thresholds. And again, just to talk about this calibration graph, we'll see part of the issue with this plan is that because without conversions, we have so much money locked up in tax deferred assets, our adjusted gross income in this case is only exponentially growing. And then when those LTC events happen at the very end of the plan, it's going to force massive withdrawals and taxes, and of course, IRMAA surcharges. So instead, I'm going to create a IRMAA strategy. And by swapping the conversion target to Medicare premium tax bracket, I can go ahead and go to this no IRMAA. I'm doing as many conversions as possible without sparking any IRMAA surcharges. So if I go ahead and hit refresh, basically, and again, I'll zoom in for everyone here. Basically, what we're seeing is the Magi is increasing early on here, again, before our RMD age, to make sure we can do conversions without sparking any IRMAA. Our other more aggressive ordinary income strategy so far sparked IRMAA surcharges because we were just focused on what ordinary income tax bracket we're in. And taking a look at the details tab, first going back to withdrawal and conversion here, one part of the strategy is where we are going to be delaying it till age 65 because that's when our Medicare premiums begin. But again, we're going to see our conversion amounts year over year. And if you remember the past strategy, this one is converting a little bit less year over year. So rather than running out of money, running out of tax deferred money to convert, we actually still retain quite the high tax deferred account balance. Hence why in the calibration tab, we're still seeing massive modified AGI towards the end of the plan, because even though we're doing conversions now, we're still retaining quite the tax deferred account balance towards the end. So, but before I get there, to show you some comparisons of why this is still beneficial, we could always jump over to this comparison tab. Because again, we are seeing 2.2 million more in ending wealth from these Roth conversions. If we go over to comparison, we can always see the value of our reference strategy, which again is a strategy in this case without any Roth conversions, versus right now our no-IRMAA strategy that we have selected here. So there's many good visuals here to compare strategies. So basically this first one is just going to be portfolio value year over year. We can see in these years we're converting, the reference strategy is actually outperforming the no-IRMAA strategy. Why? Because the no-IRMAA strategy is generating higher taxes while we're doing conversions, but not by too significant of a margin. But then while we get towards the end of the plan, so in the client's 80s, early 90s, well, the Medicare premiums that are inflating aren't getting those extra surcharges. And we also have less RMDs for less taxes. And we're just accumulating, again, that tax-free wealth as opposed to the tax-deferred wealth. Beyond that, we can just view the taxes paid time over time. So again, we're seeing the spike in the no-IRMAA strategy early on, maybe not the spike, but the increased amount in no-IRMAA early on, whereas the reference strategy ultimately actually ends up surpassing the strategy and taxes paid just again from those RMDs towards the end of the plan, and having to fully fund LTC with tax deferred money instead of a combination of both of them. And I also always like to view the required minimum distributions because that's a big reason for all of these tax savings and this accumulated wealth. Less money we have to pull out from tax deferred, less taxes, and the more we can keep in our portfolio. So this is a very significant difference, pretty much 2 million less in total RMDs from this strategy between no-IRMAA and the reference strategy here. And again, this is the strategy with no conversions, not the ordinary income reference strategy. And ultimately, we can also view the results at the end of the plan. Not only are we ending with a higher portfolio value, but it's pretty much all tax-free in our Roth conversion strategy here. This small portion of taxable is those whole life insurances paying out, but rather than about 50% of our ending portfolio value being all tax deferred, which your heirs would have to pay, taxes and fees on for those RMDs they're going to experience with those, they're also getting fully tax-free money. And because of those tax savings, the lack of those IRMAA surcharges, and the lack of significant RMDs, they accumulated a higher portfolio value as well. But what if we wanted to also try out getting rid of funding this, this LTC event at the end of the plan with our tax deferred accounts? And we can also see this in the details tab, by the way. If I scroll to the very bottom here, when the LTC events are occurring, we can see significant withdrawals from our tax deferred accounts, whereas our tax-free account balance doesn't really get touched here, besides a little bit for these LTC events in the last year. So I could also try a more aggressive IRMAA related strategy. But again, this no-IRMAA strategy, I still see as potentially a very beneficial one for my client here. So again, I'm not going to override my no-IRMAA strategy. I'm instead going to go back into the edit button here and add another strategy. and save that as well. And to begin trying out my third strategy here, I again want to make sure I'm selecting it in the action items on the left side here. And again, our focus is going to be on the Roth conversion section. And for the purpose of being apples to apples here, I'm once again not going to change, the timing on these three different strategies. And ultimately, one strategy to solve for eliminating our tax deferred balance early on to make sure it's all tax free could be extending when our conversions end. We could do conversions for a longer period of time. But another strategy I could try is just early on taking on some additional IRMAA surcharges and trading that off for no surcharges later on, but even less RMDs, and getting all of that money tax-free even sooner. So this is another option I could try here. So I'm going to go ahead and refresh that and check out the calibration tab here. So now looking at our Magi for our conversion strategy here, we do see it's significantly higher than in our other strategies here early on. We're going to go all the way up to the 220 IRMAA surcharge threshold. What's the maximum amount we can convert early on to make sure we don't jump to the next threshold of 353? And again, taking a look at the details tab to see our conversion amounts. Again, starting at 65, once we hit Medicare age, these are way more significant conversion amounts than in our other strategy. That was less than 100K year over year. But one thing we will see early on is, and the reason it's stopping again before 74 is because our tax deferred account balance has now been fully translated into tax-free early on. So this is now eliminating paying for those massive long-term care events and costs with our tax deferred. We can now pay for it in full with tax-free money. So this is another potential strategy for these clients. But again, I always recommend checking out the comparison module to, again, view those pros and cons. So just to see the slight difference between the no-IRMAA strategy, again, starting with looking at the portfolio difference here, the reference strategy now has a bigger gap between, no conversions and filling up to the tier 2 IRMAA, rather than just, maybe a few thousand, tens of thousands difference in their early 70s. We're now talking about hundreds of thousands. The no conversions is doing better because we spent so much more on Medicare earlier on. Our taxes in general, even without Medicare, were higher from these significant conversions. But again, towards the end, we're accumulating so much more wealth from lack of RMDs and lack of tax payments in general, especially when we're paying for such a big long-term care event at the end. And we can view this again, of course, in the federal tax payment. Same kind of structure for our total tax payments, but again, a little more aggressive early on for, again, less taxes later on in life. But the big thing for trying this last strategy out here was for RMDs, to eliminate them entirely. So because I completed all of my conversions by age 71 for these clients, we have $0 of RMDs throughout the entirety of the plan. Now, of course, this particular plan I'm looking at, all of these strategies seem very similar in their results. So starting with tier 2 IRMAA, or actually let's start with our regular ordinary income proposal. So this strategy is resulting in $2.4 million more in ending portfolio value from $400,029 less taxes paid and 3.3 million less in tax deferred withdrawals through the entirety of the plan. Moving on to tier 2 IRMAA, very similar results, 2.3, 380,000 and 3.1. And of course, our no-IRMAA strategy, 2.2, 135 and 616. So there can be various strategies that can be beneficial for the client in this. Some have a bigger trade-off. So my proposed strategy in tier 2 IRMAA are a little more aggressive, a little riskier early on for higher conversions, while the no-IRMAA strategy is a little bit of a safer strategy, but they all look pretty beneficial. So one tool we have to help you decide on what could be your top strategy is this very last conversion tool called the strategies. And when you first get to this page, you basically want to always hit this recalculate. So this is a feature that will solve for the top equity allocation, withdrawal sequence, as well as conversion strategies that we'll see on the bottom. It's calculating through many, many scenarios, so it does take a moment here to load. But you could also weigh your strategies with the potential strategies that the computer is calculating here in this module. And we'll keep giving this a moment, and there it goes. So ultimately, the strategy is going to calculate what are the top 5 ways with these 3 specific types of strategies that we can accumulate the highest tax adjusted ending wealth. So it will calculate the top asset location strategy, withdrawal strategy, as well as Roth conversion strategy. And in this case, what it's telling me is the Roth conversion strategy with no-IRMAA is actually going to accumulate the most wealth. Specifically, the component I was missing for my no-IRMAA, which performs slightly worse than the other strategies, was that also doing an equity allocation of this was going to be very beneficial for me as well. So I can go ahead and run that and finally see my summary of the top calculated strategy in that tool using specifically a no-IRMAA strategy. So ultimately, if I decide on a strategy that I like, or even if I haven't quite decided which strategy I want to go with in this module, there's always one final step when it comes to the strategies tab. This is also an important final step for many of these modules where we build a strategy outside of retirement. So I'm talking about tools such as the debt calculator, for example, the education module. Whenever we want to tie this back to our plan, we always want to go back to our retirement analysis tab here. So this is our Monte Carlo analysis, as I imagine many of you know. And again, the clients are already in a good spot here via this Monte Carlo simulation. But ultimately, what I'm showing you here is that if you ever want to initiate this Roth conversion or tax strategy that you built in general, you always need to come back to our retirement analysis here and into the action items and turn on the strategy of your choosing. So I could turn on my ordinary income strategy here and see how that performs now that we're introducing volatility in 1,000 random simulations. So in this case, we see a way higher ceiling on our median ending portfolio out of these 1,000 simulations. We also see more successful across our 1,000 market outcomes. But rather than, like I was doing in the other module, always comparing proposed plan versus our current plan, also what I modeled the reference strategy as back in tax strategies, I also here in retirement can build several different plans. So I could add a new plan here and kind of mimic it to our no-IRMAA strategy, which is the strategy I currently want to go with, and general concept of RightCapital. If you ever want to update, you always want to put it on the left side. And I can go ahead and toggle no-IRMAA to my no-IRMAA proposed plan here. Hit refresh. And now I am able to do a comparison between multiple different Roth conversion or tax strategies in general throughout the entirety of the plan. So I have now tied these two different Roth conversion proposals to two different proposed plans in retirement, meaning in the other modules I go to, cash flows, insurance, estate, etc., I'm able to view the output of these different strategies. Or again, make comparisons between now two Roth conversion strategies, not just our Roth conversion strategy and no Roth conversions at all. So this can really help you weigh the pros and cons between different Roth conversion strategies. And ultimately, we're seeing that the no-IRMAA strategy, while very similar to the proposed plan, which is the ordinary income Roth conversion strategy, slightly higher probability of success and slightly higher median ending portfolio value at the end of both the client plans.